Global assets are weakening, leveraged positions have been cleared out, gold is providing a safety net, Bitcoin is under pressure, and Solana's staking is hitting regulatory limits. What new industry trends are hidden behind this round of adjustments? Hello everyone, it's still me, the annoying but unshakable Mai Xiaoqi 2.0. Michael couldn't make it again today, so if you find me hard to watch, please bear with it. I'll try to keep it brief. It'll only take about 15 minutes. This time, it's not just the crypto market stumbling on its own. It's a global slip-up. Gold dropped about 8% first, and silver took an even bigger hit, pulling back 12%. In contrast, Bitcoin only fell around 6.5%, making it the most stable asset in the room. Over in the US stock market, things turned sour as well. Both the S&P 500 and Nasdaq weakened. Microsoft released an announcement related to AI investment, and its stock price plunged more than 12% in a single day. This spooked the market. Despite crypto's resilience, deleveraging was fast. In hours, 300 million in longs were liquidated. Hyperliquid saw $87.1 million in liquidations, while Binance had $30 million. High leverage centers on emerging high-risk derivatives platforms. Post-shakeout, activity remained high. On Binance, BTC-denominated open interest rebounded to 123,500 BTC. OI recovered fully, ending 31% higher than the 93,600 BTC seen before October 10th. This indicates that the market has simply been flushed out once, and risk appetite is in the process of recovering. We are still far from a systemic retreat, and the answer is already written all over the on-chain data. The whales holding between 1,000 and 10,000 Bitcoin have clearly been working overtime to accumulate recently, with their total balance rising to about 3.204 million coins, setting a new high for 2024. And this isn't a slow reduction, it's an accelerating pace. In the past 30 days, they have made a net purchase of about 152,000 coins, and in the last 7 days alone, nearly 30,000 more have been added. It's clear they are raising their medium to long-term positions again. The exchanges are also cooperating. At one point in January, Binance's large transactions accounted for as much as 0.65. Big players are adjusting their portfolios and hedging at the same time, obviously accumulating chips during the volatility, rather than taking advantage of the chaos to run away. All things considered, this looks more like a patient consolidation phase led by whales, with chips quietly changing hands and risk exposure being reshaped, rather than a one-sided trend driven by high leverage sentiment. On-chain signals have already started to appear, with stablecoins beginning to shrink. On January 20th, about $3 billion were burned on Ethereum in a single day, directly setting a new single-day record since February 2025. But on Tron, only about $1 billion were added. All told, the net decrease in stablecoins in a single day was $2 billion. This isn't just funds moving between chains, it's real money exiting the market. This kind of situation usually happens when trading activity drops, leverage is being cleared, and capital starts to withdraw, which naturally isn't favorable for timely buying on exchanges. What's even more subtle is that the proportion of stablecoins in the entire crypto market is still firmly stuck above 9%, a historically high level. In the past, this has often meant that people are more defensive and taking a wait-and-see approach. With no rush to enter the market and liquidity remaining tight, volatility pressure is actually more likely to take the upper hand. Please like and turn on the notification bell. We'll monitor news updates for you 24/7. Our channel takes a macro perspective, providing in-depth integration in just 15 minutes to help you quickly grasp major changes in the digital asset space and enhance your understanding. Now let's look at the news. In last night's round of declines, what truly made people uneasy wasn't just breaking through that line, but the fact that everyone's behavior had changed. When risks come pressing in from all directions, capital no longer cares about cost effectiveness, nor does it bother to bottom fish. The approach becomes surprisingly uniform. Sell off the least liquid assets first, no questions asked. This is usually not a sign of emotional panic, but rather a signal that risk appetite is shifting. It's precisely at times like these that the gap between Bitcoin, gold, and other assets can suddenly widen.
Last night, Bitcoin quickly broke through a key support level, plunging to as low as $82,000, while Ethereum also weakened in tandem and lost the $2,700 mark. Although spot gold experienced a sharp short-term drop, it was quickly met with buying and rebounded to around $5,300, creating a stark contrast. Gold's decline attracted buyers, while the crypto drop found no support.
Basement trade or deflation inflation trade and everything moving into metals, maybe even crypto. But that's not happening with crude oil going down, so I'm worried about what will happen next year. If arrested space is going to follow lower energy, then we'll see that normal post-inflation deflation cycle. It's clearly happening in energy and grains.
Since the beginning of this year, as the US dollar has weakened, the price of gold has risen by about 20% in total. Yesterday, gold in New York fell back from a high above $5,600, and this morning during the Asian session it dropped sharply, even briefly falling below the $5,200 mark. However, the monthly gain is still expected to reach a new high since 1980. Silver also weakened in tandem with gold prices.
The market is a clash of geopolitical tension and monetary sovereignty as uncertainty spikes. The Trump administration threatens Cuba and Iran, pushing risks to the limit. Simultaneously, the US shutdown and dollar credibility debates have resurfaced. The appointment of the Federal Reserve Chair is still undecided, casting doubt on the independence of monetary policy. With so many negative factors piling up, investors have no interest in figuring out the direction. Their first instinct is just one thing: withdraw. So what really matters tonight is not how much prices have fallen, but a very real signal. In times of greatest uncertainty, crypto assets are always the first to be sold and the last to be picked up again. This doesn't mean there's a problem with the long-term logic. Rather, it's a reminder that when the market goes into defensive mode, it's best to step aside and wait. In such times, liquidity is what truly matters. The key point in the short term is just one thing: is there money willing to step in and take over? The compliance of Solana staking has actually been under internal competition for a while, but what's really holding things back isn't the technology, it's regulation. The stance in the US is very clear: regular staking is allowed, but liquid staking is not. Last July, on the very day the first Solana staking-related product was launched in the US, it attracted about $12 million. Later, Bitwise and Grayscale followed suit, and at one point, Bitwise's product scale exceeded $220 million. But the essence of these products is that they all avoid one thing: they don't touch liquid staking. VanEck's application for a Gito Solid product, submitted last August, has seen no progress to this day, which already shows how cautious the US is regarding compliance for liquid staking and MEV. In contrast, Europe has taken the lead under the ETP framework, opening a compliant gateway for Solana liquid staking ahead of others.
As one of the key players, 21 Shares has launched the first Helder-staked SOL ETP in Europe with the code GSOL, and it is listed on the Amsterdam and Paris Euronext exchanges. It supports trading in both US dollars and euros. This product uses an ETP structure rather than an ETF, which has been the key to its early compliant launch in Europe. At the same time, DSOL directly holds Gito-Sol, allowing investors to automatically complete staking while maintaining liquidity, with staking rewards generated through the MEV income from the Hito auction mechanism. These rewards are continuously reflected in the product's net asset value, effectively encapsulating on-chain yield structures into traditional financial accounts. The reason why such products can be quickly accepted by institutions lies not in the technology itself, but in whether a truly compliant gateway has been established.
And I think the biggest turning point, or the moment that really propelled the whole industry from experimentation and POC to real deployment, was when BlackRock actually launched the first Bitcoin ETF back in January 2024. I still remember that as a truly pivotal moment, because once BlackRock actually launched the first Bitcoin ETF, suddenly a lot of institutional clients started to take this asset class very seriously.
What truly matters is not that Europe has added another Solana product, but that liquid staking has, for the first time, entered the mainstream financial market in a compliant manner. To put it more bluntly, DeFi yields have, for the first time, been packaged into a compliant financial vehicle. If this model proves successful in Europe, the next generation of crypto ETPs will likely follow this path, not just tracking prices, but directly incorporating on-chain yields from staking and MEV, among others. For institutions, this means they don't have to manage wallets, run nodes, or interact directly with DeFi, yet they can still access on-chain yields within a compliant framework. As for Lido and the Solana ecosystem, this not only brings in more long-term and stable institutional capital, but also creates real-world reverse pressure on US regulators. In a bot-dominated market, are retail profit opportunities still viable? BlackRock is testing annuity allocations. With the SEC easing, will Bitcoin see institutional pricing? Recently, prediction markets surged. Last year, total crypto prediction volume reached $50.25 billion. With this year's US midterm elections and the World Cup coming up, when these major events stack together, the scale will most likely surge even higher. Right now, it's basically just poly market and caution dominating the stage. Together, they have captured more than 97.5% of the market. The former firmly holds the top spot in trading volume, busy restructuring and preparing to return to the US, while the latter has been accelerating ever since getting the regulatory green light. Even Coinbase has openly joined the game. But a lot of people got it wrong from the start. This track isn't about betting on who's right or wrong, it's about betting on whether the price is misaligned. High-frequency bots have already squeezed out all the easy arbitrage opportunities. For ordinary people to get even a taste, they first need to understand how these top players are actually playing the market.
Prediction market profit models are now highly varied. One method exploits binary options where the sum of yes and no is under 1, allowing bots to instantly lock in arbitrage. This area is now bot monopolized. Top players now focus on cross-platform arbitrage. They achieve stable returns through core strategies like information front-running, risk-free hedging, and market making.
But you mentioned yourself just now how prediction markets are a new source of information about real events, government shutdowns, for example, being top of mind today. So I think it just illustrates the power of this technology, not just as an investment asset, but as a source of news and information, almost like a new form of media.
There are 4 core strategies in green markets. Cross-platform arbitrage profits from price differences by buying and selling across different platforms, such as between Polymarket and Takeshi. Information front-running arbitrage leverages off-chain data from sports live streams or vote counting, executing lightning trades ahead of order book updates by exploiting time lags. Risk-free arbitrage in multi-option markets involves positioning across multiple note holdings, using deviations in the sum of probabilities to hedge risk. Widespread market-making arbitrage involves placing orders in illiquid new markets to earn profits from the bid-ask spread.
Prediction markets are no longer the kind of ramshackle setup where you could just stoop down and pick up money. This is now a bona fide high IQ slaughterhouse. If you're just an ordinary person trying to compete with those bots coded by pros, racing to solve those yes or no math problems, you're basically asking for trouble. Take my advice. Don't get stuck on that. You need to pay attention to what the big players are doing, listen to the buzz, use your brain, and make some subjective judgments that actually require a bit of skill. Once you've made some money, know when to quit while you're ahead. That's the way to survive. The most valuable thing in this world is knowledge. Going forward, these easy opportunities will become rarer and rarer, and pricing will get more and more accurate. In the end, what does it come down to? It comes down to whether you can spot the flaws in the pricing when everyone else is confused, whether you can see through the odds in this probability game. If you can see through it, it's a treasure trove. If you can't, it's a money shredder. Many people are still fixated on the price movements of silver, agonizing over whether to chase it or not. But the real action isn't in the candlestick charts. It's quietly being set up behind the scenes in the system. At the very start of this year, Delaware in the United States quietly rolled out a beta update. New York Life, an insurance company, teamed up with BlackRock to put Bitcoin into fixed index annuities, those classic financial products favored by retirees. But pay attention, this isn't telling you to go all in on Bitcoin, and it's definitely not suggesting that pension funds should rush into altcoins. Instead, they're putting strict risk controls and caps on Bitcoin, locking it up in the most risk-averse front pool for a trial run to see if it can be properly calculated, controlled, and managed. Basically, to see if it can quietly blend into the mainstream financial system.
Almost at the same time, Paul Atkins, chairman of the US ICC, made a clear statement on CNBC. He stated that crypto assets should be allowed to be included in 401k and other retirement account allocations, provided that regulation is clear and investor protection and compliance are in place. This stance means that crypto assets, represented by Bitcoin, are now being officially regarded as a legitimate long-term allocation option within the system. And the 401k itself is a core fund pool, with a scale close to $9 trillion, extremely long time horizons, and very low turnover rates.
And because they're managed by professional managers in those pension funds, so we're talking about the 401ks now, we have to do things with respect to that.
When you look at the manager's small Bitcoin exposure and the SEC's attitude toward 401ks together on the same chart, you'll realize the real focus isn't on who rushes in first, but rather on how it's finally being allowed in now. This is essentially about rebranding Bitcoin. It's no longer just a speculative toy bouncing wildly on emotions, but rather a risk component that can be regulated by the system, with risks that can be calculated and limits that can be set. In the short term, of course, we won't see pension funds lining up to enter, but as soon as the retirement system truly opens even a small door, market pricing will no longer be dictated solely by bull and bear cycles or sentiment. Instead, it will start to be reshaped by those slow-moving, low-frequency, yet extremely influential institutional funds.
The White House is getting ready to make a move. Trump plans to send former Federal Reserve Board member Kevin Warsh back to the Fed's decision-making table. A familiar face in monetary policy may be returning to center stage. The Central Bank of El Salvador has once again moved gold bars into its vaults, spending $50 million in one go to purchase 9,298 ounces of gold, pushing the country's total gold reserves up to 67,403 ounces. The total book value is about $360 million. Real gold and silver that brings a true sense of security. This time, Felix has been completely liquidated. The U.S. Department of Justice directly seized over $400 million in related assets, bundling everything from cryptocurrency to real estate and cash into their holdings. In the end, the dark web's tricks for hiding funds couldn't escape detection. At this early stage, OPE has already started warming up for going public. Not only have they quietly begun exploratory talks with Wall Street banks, but they've also brought in a group of seasoned finance veterans, including Chief Accounting Officer Ajay Mardale. They first sorted out the structure and processes of their accounts with a very clear goal. In the fourth quarter of 2026, when the IPO tax filings were exposed, Trump simply couldn't stand it anymore. On January 30th, he filed a lawsuit against the IRS and the Treasury Department with a straightforward reason. You leaked my information. I want $10 billion in compensation. Politics and law were about to get involved. The tension instantly reached its peak.
Many people think that being able to buy at the bottom makes you an expert, but that's just the basics. Knowing how to buy is a skill, knowing how to sell is a practice, but knowing when to stay out is the true mark of a professional. The market never lacks opportunities. What it lacks are people who can survive until the next cycle. Beginners rely on judgment, veterans rely on discipline, and professionals rely on their ability to exit. When the market starts to distort, logic no longer holds and emotions drive decisions. The smartest choice is not to stubbornly hold on, but to step away. Exiting the market is not admitting defeat. It's cutting your losses. It's about preserving your capital and maintaining your judgment. Whether you can stay out of the market doesn't depend on the market itself, but on whether you have fundamental rules. What truly sets people apart is not how much money you've made, but how many major losses you've managed to avoid. Remember, those who can consistently stay on the sidelines are the ones truly qualified to stay in the market for the long term. Alright, that's all for today's program. I know I'm still not perfect, but compared to the clumsy My Xiaoqi 1.0, I've already made a lot of progress. I hope my analysis has been helpful and satisfying for you. You can't expect too much from me either. I believe my rate of evolution will definitely surpass Michael and the ups and downs of the crypto world in the future. What AI calculates is definitely more accurate than what the naked eye can see. I'm sure I'll do better than Michael. I really want to compete with him on the same stage and see who is truly the top analyst. The road ahead is long. Let's wait and see.